Brad Williams, Frugal Finance, estimate market value of a bond. The market value of debt can be difficult to obtain directly from a publicly traded company, since very few firms have all their debt in the form of bonds outstanding trading in the market. A lot of companies have non-traded debt, such as bank debt, which is stated in book value terms, but not market value terms. An easy way to convert book value debt into market value debt is to look at the entire debt on the books as one coupon bond with a coupon set equal to the interest expense on all the debt and the maturity set equal to the face value weighted average maturity of the debt. And then to value this coupon bond at the current cost of debt for the company. So the market value of $1 billion in debt with interest expense of $60 million and a 6-year maturity with the current cost of debt at 7.5% can be projected as follows. Market value, $1 million, coupon 6, current interest rate, 7.5%, 6 value. And we're just gonna steal this particular formula here. And we can do this if you want, equals formula, text. And this is just gonna take this and copy it next door. And here it's hard-coded, so it's easier to read. So I'm just gonna grab this and just park it underneath. Copy, paste, and then you just want to deactivate it and just put a space there. This is the exact same thing. You can see we're taking the face value, we're taking the one, and it looks like we're discounting the cash flows up through 6. Then you can see this looks like the annuity formula that we've done before, time and time again. This will go 930. Let's say the market value of bonds is 1603. And we have a coupon of 6, 7, maturity in years. So now we have 15305. Estimated market value of a bond. To find the market value of the bond, we compute the present value of the remaining payments at the market interest rate. Suppose that the rate is currently 15%. We have present value 15 divided by 12, 15 times 12, 772 equals 55,160. Thus, the market value of the loan is 55,160 as compared to the loan balance of 71,842. I guess I probably could say we have a loan of outstanding of 71 million. The market value is 55,161. The market value of 55,161 is the amount that the lender would receive if the loan were sold to another lender today. We could say that the above loan is selling at a discount. The amount of the difference in this case would be 71,842 minus 55 million. We could also say the mortgage is selling at a discount of 23% of its face value. The market value of the loan is lower than the contract loan balance in this example because interest rates have risen relative to the interest rate, 10%, at which the loan was originated some 10 years ago. Borrower is required to make payments based on 10%, even though the market rates have risen to 15%. This is one reason why adjustable rate mortgages have become attractive to lenders. With an adjustable rate mortgage, the market value of the outstanding loan will not differ as much as when compared to a new loan originated at market rates of interest. In fact, if the interest rate of the outstanding loan could be adjusted at each payment interval, and there were no limitations on the amount of the adjustment, then the contract rate on the loan would always equal the market rate. In this event, the loan balance and market value for such a loan would always be equal because future payments would be based on current rates of interest. Clearly, this was written long ago. That problem has been resolved for the most part with swaps. You can match whatever criteria you need, and you can pretty much set up a swap to handle that difference. And here we have this 60,000 market value of bonds, 80,000, 10%, 10%, cost of debt 8%, 15%, gain or loss 68, and then here 54 minus 25, then it's changed 464. You can see. And I guess this is just the difference here. These are just hypotheticals, and I'm basing this off of this original amount. The critical thing here is just to understand this particular equation. If you haven't seen it yet, you will see it time and time and time again. That's a preview. Brad Williams, Frugal Finance. Thanks for watching.